We entered 2020 with a positive risk stance. We said back in December that returns this year were likely to be lower than what we saw last year, but that ample liquidity and a gradual economic recovery were supporting being long risk overall. We added that risks will actually mount as the year wears on, a view that can probably be summed up as short vol in H1, long vol in H2. The same is true now. So we keep our overweight equity stance and underweight fixed income. Our view was tested early this year with tensions in the Middle East flaring up. The market response was broadly what we'd been expecting given the ample liquidity in financial system, i.e. an opportunity to add risk as opposed to an excuse to reduce it. We look at a couple of historical precedents which can provide some indication of what investors should be doing and how to treat these kind of episodes. So we look at the Iraq War of 2003, but also at the Gulf War that started in 1990. These were two very different episodes. The Gulf War was a quick affair with oil output restored in a relatively short period of time, whereas the Iraq War dragged on for nearly a decade, and it took more than 5 years for the energy industry to recover from that particular instance. The bottom line is that Middle East risks are real, but the risk reward is just not compelling enough for investors to position for it. Looking ahead, we believe that the current economic recovery, which is now underway, will continue. There are more countries now at the recovery stage of the respective cycles than there are in slowdown, i.e. this global slowdown wave that we saw at the end of last year seems to be over now. The OECD composite leading indicator is now at the recovery stage as well, and it's been there for 2 months, since October. This is the phase of the cycle where risk assets tend to post the best performance throughout the cycle. Now, no two cycles are the same, and this particular one is particularly unusual. Normally, asset classes, particularly risk assets, enter the recovery stage of the cycle with valuations fairly low, and that's why returns tend to be higher than average. Not so this time. Valuations are quite expensive to begin with, and we think that this will cap the upside for investors this year, which is something we mentioned earlier. And that means that returns are probably going to disappoint compared to previous recovery episodes. But earnings should nonetheless recover from last year's decline. We're starting to see a bottoming out in macro indicators, and soon enough, earnings should recover as well. And that means that we keep our overweight equities stance, and that, of course, is offset by an underweight fixed income where valuations are quite expensive as well, compared to fundamental indicators such as growth and inflation, but also relative to some cyclical indicators such as the PMIs or the ISMs. So we stay 11% overweight on equities, but this month we rotate partly from DMs to EMs with a more neutral stance between the two. At the same time, we keep our fixed income allocation unchanged in developed markets, but we reduce our emerging market allocation by 1%. And we use that percentage point to reduce our underweight energy commodities.